kind of a live market analysis over here, and of course, we do have Q&A segment. Okay, so of course, if you have any questions, feel free to put it into the chat, and from there, that'll be notified, and of course, we can then look at your questions or any particular instruments that you'd like me to share my analysis. Feel free to put it up as well. Okay, and of course, for those of you who are pretty new, maybe you missed out some of our previous session. Okay, just a very, very quick introduction and kind of a little bit of housekeeping over here. So today's session is being sponsored by KVB. All right, and of course, for those of you who are fairly new to KVB, feel free to click on the link that you can find below the description if you're watching it on the YouTube screen right now or on Facebook. Okay, you can actually find the link in the description text. And of course, that would then direct you to the website and you can actually find out more information about KVB. Now, I also just want to very, very quickly before we start the session to just bring your kind of attention to a very unique promotion that KVB is running until the end of this year, which is basically end of this month, right? We're in December. So the promotion over here, I just want to bring your attention to, okay, which I believe that is very, very unique. It's called a switch bonus. Of course, you can again, to assess this information, all you have to do is kind of register for your account. Once you log in, and then on the left, right, you can navigate towards rewards. And from there, if you click on the switch bonus, okay, this is where you can find out a bit more information about what particular this promotion is, right? And just very, very quick and brief kind of intro to it. Basically, this is a bonus where you can actually kind of claim if you kind of like have a proof, right, that you previously used in a platform or another account, and then you kind of transfer over. This is where you can actually claim up to $2,000, right, as a bonus if you do that switch, right? There are also more details in terms of like double the rewards, right? But of course, I'm not gonna spend too much time to go into the details of all this. But I just really want to bring your attention and kind of awareness that this is something very unique, which you can actually fully kind of make full use of, as we progress towards the end of the year, because this is just going to be ending by this month end, right? So again, for those of you who are interested to find out a bit more information, just click on the link and it will kind of redirect you to the website. And of course, you can kind of approach the support team from KVB. All right. So with that said, I will do a very quick introduction about myself as well, especially for those of you who are first time joining us. For those of you who have been joining us for the past couple of sessions, of course, welcome back. So my name is Yong. Personally, I've been trading the market since 2012 and been doing this full time since 2015. Okay. And of course, in my journey, basically, I've kind of come across many different techniques and strategies. And today, what I've done is to kind of like put together this framework called DSC. It basically stands for Direction, Setup, and Context, which give us that framework and clarity in approaching the market. Right, we need to have a directional bias established. We need to have a clear setup, and then we need to add a layer of context to kind of gel everything together, right? Which is something that will apply it in the live market today, right? DSE was actually covered in, I think, the second session or the first session. I can't really recall. I think it's the first session, right? Where I kind of dive deep into the DSE framework and kind of share, the details on how we actually and apply the framework into developing a strategy and approach, which basically includes the usage of Elliott wave principles plus the smart money concept SMC, okay, and kind of put them together. So today, what will happen is I'm gonna walk through the markets, go through the markets together with you guys, and really show you the application of the SC, right? In the lens of my technique, right? Because this framework itself, it's universal in a way where, if you have your own ways and methods of analyzing direction, you still need that, right? So it doesn't necessarily need to be the techniques and the specific matter like Elliott wave that I'm using. Okay, but hopefully today by sharing with you the techniques I'm using, you get a little bit inspired as well, and that kind of spark your interest into diving a little bit deeper, right, into the concepts of Elliott wave as well as SMC. Great. Um, cool. So with that said, right, I will. I think what I'll do, okay, is I will actually run through. Let me just very very quickly open the blank chart. Okay. I will very, very quickly run through a summarized version for the benefits of everyone of the DSC framework and the slight details on how I analyze direction, how I forecast directional bias, what's the setup I use, and some of the 8 layers of context. And then we go into the live market. And then I think that would help you to refresh, right? What are the techniques, and then kind of witness how that is being applied in the market. Okay. So very, very quickly, DSC here, of course, stands for direction, right? Setup and context. Okay. So for me, directional bias, I'm using very simple foundation and principles of Elliott wave. But of course, if you have more experience, you're gonna be able to dive a little bit deeper into Elliott wave. But the simplest kind of foundation, and I would say one of the most important foundation of Elliott wave, is understanding impulse and correction, right? Impulse is basically when the market move off in a very, very strong momentum. And oftentimes when it pulls back correctively, which means it's generally slower without much momentum, right? Then what this kind of suggests is whenever we see this kind of pattern, right? Impulse plus a correction, there's a very high probability the market will continue in its prevailing trend, okay, which is upwards, right? And of course, if you kind of flip that, if you have a strong impulse down followed by a corrective pullback, then very high probability the market will continue moving lower after that. So this kind of frame the directional bias that we can focus, right? If we see a pattern that is something that we can recognize, we have a clear directional bias. Okay. Another pattern within Elliott wave that help us to kind of establish our directional bias is the crawl pattern. So instead of like impulsive move and then a corrective pullback, the crawl pattern is where the market continues to go higher, but starts to slow down in momentum. This often indicates some sort of a pullback or reversal, right? So we kind of like when we see a pattern like that, we call it a crawl structure, right? So same thing here, it comes out initially very fast and then it starts to slow down. So whenever we see something like that, we know that there's a very high probability the market would reverse. Okay. So again, that kind of indicates some sort of a direction we can focus on. Okay, so that's the foundation, that's the base, right? I'm not gonna go into too details because then that would take up the entire of the today's session, but this is really just for a quick refresher and a summarized version. Okay, so that's direction, right? But directional bias itself is not is not everything. It's not gonna be complete. Because every time we pick a direction, we know that there's a high probability move to a certain direction. We still need to know when to get in and which price to get in, right? And that's where the setup phase comes in, right? Which basically is a set of conditions and criteria that tell us when to get in, when to get out. What are some of the prerequisites that we need to see before we can execute a trade. So the setup that I'm using right now to kind of execute all my trades are going to be based on SMC model, the smart money concept. Which today, if I'm going to talk about a buy trade setup, right, I would ideally want to see some sort of a model that looks something like this, right? So there are a few components within this pattern structure. The first one here, you can see the market initially is coming down, and then we have like lower low, lower high, right? And we kind of see this low being broken, but very, very quickly, the market kind of reverses in the opposite direction with very strong momentum and successfully break the previous high. Okay, so we have like a break of low, a break of high, right? So in SMC model, this is called liquidity sweep, and this is called break of structure. Okay, and very important over here is when this breaks the previous structure, we need it to break it with momentum, right? So kind of like in Elliott wave term, it's an impulse. Okay, fast and strong move. In a very technical way of defining a fast and strong move is that it usually leaves behind market imbalances, and in SMC we call it FVG, fair value gap, right? And then what I do is I combine it with Fibonacci retracement. If the market pulls back to a certain Fib level, um, then that's where we're going to look to execute our trade with our stop and our target. Okay, so this is the buy setup model, right? Of course, it's not going to be looking like exactly picture perfect in a real life market. But later I'll show you some examples. We don't really have a lot set up at the current moment in today's context, but we do have one, which is the pound yen. I'm going to talk about that in a while as well. Then you can really see how this setup is being applied, right? So this is the buy kind of model, right? Buy trade model, and then the sell model is basically you have liquidity sweep, breaker structure, a pullback towards Fib level. Then this is where we look to sell it, stop loss, and take profit. Okay, kind of the reverse of things. So that's the setup, right? Again, a very, very summarized version of it. Okay, so if you think of it, right, direction tells you where, okay, right, like which direction that you want to be focusing on by yourself, right? Or if there's no clear direction of bias, then you don't trade. The setup kind of give you the clarity and the answers towards when to buy or when to sell, when to execute, right? And how do we manage our risks by having a clear, defined entry point, stop loss, and take profit, right? And then the context that comes in over here, it's where the application of like multi-time frame alignment, understanding the overall kind of macro environment. Is there like some major news that's upcoming? Do we want to take note of it? And then of course, understanding, are we taking a kind of like alignment in the overall direction, or are we trading just the short-term pullback? How are we then going to be managing our trade differently? In terms of like risks and position sizing. So those are all under context, right? Like things that gel the entire trading plan together. Okay. So why I want to do this quick summarized version here is so that when we look into the market now, right, today, at least you have a refresh idea on like what the DSC framework is, and then you can really see how that is being applied. Okay. Now, what I would do here is I would jump straight into pound yen first so that you can really see how this is being applied. Okay, and then we'll look at other instruments as well. Okay, and then I'll share with you like even though we don't have a setup for other instruments today, I'll share with you like what you need to take note of. Um, as these setups might build up maybe later part of this week or even going into early next week. Okay, so let's take a look at pound yen. Okay, so my way of doing it is I'm more of a swing trade, so I often look at the H4 as my higher time frame and the hourly as my execution time frame, which means on a 4 hour I'll be using it to identify the general direction I want to focus on, identify the key areas that I want to look into, and then on the hourly time frame is where I look for the setup to execute the trade. Okay, so if you take a look at the 4 hour perspective on pound yen, okay, now this one here has a little bit of advanced element, um, but I'll walk you through the thought process over here, right? So I think before this entire move, you can see the market actually went up with momentum. It came down generally slower. That's what I meant by impulse correction, and then you can see how the pattern actually evolved according to the high probability direction, right? Now, right now where we are is that we have this pretty strong move to the upside, and the market is starting to show early sign of a pullback. Now, this is a principle that I also use in the market. Is that whenever the market move in one particular direction for an extended period of time, meaning it's kind of like extended, it's kind of like stretching itself a little bit too far, it tends to eventually pull back, right? That's a tendency of doing that. So if you take a look at pound yen here right now, right, from this low to this high, to be very honest, we don't really have some sort of a meaningful pullback so far, right? I mean, we have some minor pullback here and there, but it's not really a meaningful one, right? So what is a meaningful pullback? Is something of this scale, is something of this scale, or even as a whole. Okay, you realize that we don't really have it, right? This is like so small. Okay, so what this means is that from a perspective here is that this here to this here is one move, is considered as one swing. And because it's kind of like extended, there's a very high probability the market would start to do some sort of a pullback. Okay. So that's again a principle to give me some sort of a directional bias, right? Kind of like a compass so that I kind of have an idea where do I want to be focusing on, right? Is it going to be buy focus or is it going to sell focus? So that's the first layer, right? And then what I do next is I include in some Fibonacci ratios, right? So the 50 and the 6.8 retracement is basically taking from this low to this high. 50% is the halfway mark, and then 6.8 is basically your golden ratio. Now, does it mean that the market is always going to come back towards 50 and 6.8? No, but 50 and 6.8 can give us some sort of a reference point, right? Or some sort of what we call an expectation. Okay. So the idea here is we are assessing, all right, if I'm going to expect a pullback, where would this pullback likely complete? And that's where we use Fibonacci to say, all right, this is some key level. There's a very high possibility the market will pull back towards this area. Okay. So why is this important? Because this kind of give me an assessment, all right, from where we are right now to where potentially price can travel. Is there sufficient room for me to actually execute a trade, right? So this is a little bit of an element of a context, right? Understanding, right? If I'm going to look to sell and I kind of look at this and say, all right, from where we are right now to potentially where the market is going to go, is it worth kind of capitalizing on this move, right? If the move is too small, then maybe it's not worth it because then the risk reward ratio doesn't make sense. Okay. So in this case here, you can see it's generally worth it. The reason is because, we're here. And then, of course, this is the major invalidation point, which means if market cross that level, it's no longer valid. So that's the major invalidation. And of course, this is here, right? So you kind of just very, very visual comparison. It makes sense. Okay. So this is the application of directional bias, right? I'm just kind of establishing the story. I'm building up the story in terms of, okay, what's happening on this pair? Is there an opportunity? Is there a direction that is higher probability, right? Which means it's clear where the market would likely go next. Now, as part of the context application as well, right? You can clearly see that the overall direction is bullish, but we are looking to sell, which means we are technically taking or looking to trade the market as a retracement, right? So some sort of an understanding of a counter trend. Okay. So this is a layer of context as well, which means today my direction here is sell, but then I'm looking at it as a sell as part of a retracement. Okay. So this one here, this information, this context, I'm going to put it, as a background information. Okay, so you can see context kind of the application here um is a little mixed into the whole process, right? It's not like, oh, I need to do direction, I need to do setup there. I only look at the overall context. Context is something that as we build up the case, as we build up the trade story, we're gonna interject context along the way, right? But usually the first thing I do is always direction. Do I have a clear direction bias? If there is, then only we start building a thing, right? If there isn't a clear direction bias, then there's no need to really spend too much time um, furthering your analysis because then you rather spend your resources on something else, right? So this is where we are right now, right? So we have that clear kind of directional bias. We have some context layered onto it, okay? So once I have all these things, right, then the next thing that I want to ask is, okay, if I'm interested in selling this, do I have a setup? Do I have like the high probability criteria and conditions being met where um, when I execute a trade at a specific level, the risk reward makes sense to me, the probability of, the trade successfully kind of like take profit is there, right? And that's where we move down to a lower time frame. Okay, kind of remove a little bit of all this here first, right? We move into a lower time frame, which is the H1, and we start to look for the trade setup that I kind of give a summary just now, right? Which is today, if I'm going to sell, the setup looks something like this. Okay, so I want to have a liquidity sweep, some sort of a fake break, and then I want to have a breakout structure, right, which is breaking the previous low. And I want this move here to be strong where we kind of see a little bit of a fair value gap market imbalance. And then we wait for the pullback, and then I use a certain fit level to execute it, right? So this is the model of a sell. Now, if you kind of look at it at the current market, right, it's not going to be, like as I mentioned, it's not going to be picture perfect. Okay. But can you see a little bit of a triple top here? Or, if you take this as one, you have a little bit of a mini double top. Okay. It's not technically a fake break, but it's kind of like the market attempt to break the top, but failed. Okay. So that is potentially what we call a liquidity sweep. Now, you still have this high here and then this high here. Of course, that is a very obvious break. But once it breaks, what happened? The market reverses very quickly to downside, which is this part here. Okay. Now this reverses did not really break this low yet, but it managed to break this and it managed to break this. So from the model itself, again, we're not going to look for exactly the same kind of like model all the time, but you can see elements of it, right? So in terms of SMC, right, this is where we start to label this here as a potential, what we call liquidity, right? Of course, the top here also as a potential liquidity, right? Then we have this low here broken. Okay, I would technically put this as a CISD, which stands for change in state of delivery. And then this part here as a CHOCH, which is change of character, right? Again, it's just different terminologies and names, but basically just kind of indicate that it's a sign of a reversal, right? Because lows has been broken. Okay. Now, obviously, you can see this push down here is pretty strong. I think more clearly you can see it on the H4 time frame, right? Where we have this entire block of what we call fair value gap, right? So as a quick refresher, what's a fair value gap is where you have this candle and the third candle, meaning like three candles formation, the one on the left and the one on the right, did not overlap, right? So you can see this low, this low and this high, that's a gap. That's essentially your fair value gap, right? So when we have a fair value gap, um, that's another condition and criteria we want to see. Okay, so we have the model there, right? We have liquidity sweep, we have change of character, break of structure, we have fair value gap, all good. Okay, then what we do next is we take fibs, and I'm gonna take from this swing high to the swing low. Okay, and for me, I'm just simply using the 67 retracement now. It's not like a super magical number. It's just that from a ratio perspective, if today I'm gonna execute a trade at the 67 fit, and then let's say I'm just gonna use a 2. Okay, and let's say my stop is just gonna be the swing high here, which is 100% Fibonacci retracement, and then my target is at swing low, which is 0%. The ratio would often give me average 1:2. Okay, I mean, does the market always retrace to 67 nicely and then kind of react from there? No, right? Sometimes it goes a little bit shorter than 67, which we might miss the trade. Sometimes it goes a little bit beyond that, but it's fine, right? We're not again looking for perfection. But the idea here is when we take the 67, it's just really also considering the risk to reward ratio on the fit ratio perspective is going to be giving you 1:2. Okay. And ideally, what we want to see here is that the entry zone has some sort of a confluence with the fair value gap. Okay. So in this case, you can see we have that, right? So that's the basic model of our setup. Now, in the context element of the setup here is where I like to say and add on the part where I want to see price pull back in some sort of a corrective manner, which means I do not want the price to just zoom and kind of start tagging me in very quickly after as part of the pullback, right? Because if this is gonna go down and then it is come out very quickly, it means the momentum to the upside is strong. Then selling it doesn't make sense. Okay. So in a way, I want to see the market pull back towards my entry zone in a corrective fashion, meaning you need to be patient and give it a little bit of time. All right. I mean, today we have this push. Didn't really tag my entry, came close. Like a lot of times traders would feel, wow, a little bit wasted. I should have, put my entry a little bit lower. But for me, my perspective here is a little bit different. Okay. This is a little bit strong. It did not tag fantastic. I want this to come down a little bit. Maybe by tonight, it continue to come down a little bit. Maybe tomorrow morning, continue to come down like that. And then London market tomorrow, it starts to go back towards my entry. Great. Because if you start to look at it, then we have this as a corrective pullback, meaning price really take some time to pull back towards our entry. Okay. That's one layer of context I would love to see. Now, another layer of context that adds a little bit of a higher probability is that this is our entry. Prior to our entry, if we have another minor kind of like high here, we call it internal high. That's great as well because then this high here from an SMC perspective can act as a internal liquidity sweep, right? Which means market likes to break highs and lows just to sweep liquidity. Okay, that means if this comes back down and then starts going up, as it tags into the entry, it also breaks that high, right? So the SMC principle is that, oh, it traps those buyers, and then that's where the smart money sell it to balance off that liquidity, right? Because to sell it, you need buyers, and then how to kind of encourage people to come into the market, they break this high. Okay, some sort of a simplified understanding of it. And then from there, that's the additional confluence that I would like to see, right? So that's the context application of the model as well. Okay. So if you look at it, right, the whole process here, so this is exactly the setup I'm looking at this moment, which is basically a pending order, right? So for me, because I do swing trade, a lot of all this are pending orders. Okay, meaning waiting to entry. If price tag it, then that's where we get involved, right? So stop loss and take profit. Now, a little bit on the context of take profit as well. You can see that this is the initial kind of like standard setup, which gives us 1:2. But if you apply the context element of higher time frame, right, it kind of indicates that okay, price can potentially travel towards 203.15. Okay, can I consider to maybe kind of like what if today I don't take profit here, but I go to 203.15, right? Which means I'm gonna aim all the way towards the higher time frame target. Okay, that trade risk reward ratio increases to 5.6, right? Which is very fantastic because today, if you're going to take 1% risk on average per trade, or what we call 1R, this trade is going to return you 5.6R, right? Or 5.6 times whatever you risk, which is great, right? Because if today your win rate is just, let's say, 50-50, it's still very profitable, right? If today your win rate is 60%, it's even better. Okay. So to me, risk reward ratio is quite important, right? It's almost as important as the win rate. Okay. Um, so that's the context of higher time frame application as well, right? But of course, the idea here is today, because we're looking at this as a counter trend, we're looking at this as a pullback. So I actually also more than happy to just take profit at whatever swing low here is, which is 1:2, the standard. Okay. Now, if today the context of this trade is we are following the larger kind of like market trend, then obviously you can go for extended to profit or extended target, right? So again, that's the application of context, right? So you can see the whole process of the DSC framework, right? In particular, in terms of the method that I'm using, in terms of like any wave as a direction, some FIPS as key levels, and then SMC model as an entry setup. It's a very, very systematic process, right? There's really no guesswork on it, right? There's no like, should I do this? Should I do that? Right? Because if you have a framework as a guiding process, um, then it kind of eliminates and takes away a lot of the guesswork, which is very, very important in trading. Because if today you have too many kind of like discretionary element, then um, it's not going to be consistent in your approach. Okay, so bear in mind that it doesn't need to be super complex or over complicated as well, right? Yeah, some of this model, some of these principles we're using, definitely it takes time to practice. It needs a little bit of experience in the market, but it's not something that is kind of overcomplicated where we put 10 things into the chart and then you need to take note of so many, aspects of it. It's a very, very simple framework. It's a very, very simple model. And it works, right? Again, I'm not saying that this is gonna be 100% win rate kind of thing. There's no such things. But the win rate is somewhere between 55 to 65, right? Of course, some months will be a little bit lower, maybe on the 55 range. Some months can go up as 65 range or even 70% win rate. Uh, but then don't think of just the win rate because my average risk to reward ratio is 1:2. Okay, so even if it's 55 kind of accuracy with a average risk reward of 1:2, it's still basically very, very profitable. Okay, so this is the trade I'm looking at for pound yen, right? So just want to spend a little bit more time and really dive very deep into this part here to give you the idea of how the application works. Okay. Now, with that said, right, I'm just gonna highlight a couple of I think pairs here that I strongly believe is worth having it in your watch list because there are kind of like possibility of them setting up um at least going towards like maybe this week or early next week, right? Now I'm not saying that definitely they're gonna have, but I'm just saying that there's a very high probability or higher probability that it will happen, right? So let's take a look at the pound yen. Okay. So pound yen, sorry, not pound yen, pound dollar. Okay. So pound dollar over here again on a high time frame, we always start off with direction. Okay. So what we are looking at here as a Elliott wave framework is we have this low, we have the market 1, 2, 3. So that's a simple three wave structure completed. So I also add in a little bit of Fib confluence here. You can see how the market is kind of reacting off that key area. But of course, we need more confirmation, right? Because we want to see a little bit more of an impulsive push down. We want to see that momentum push down and then the market pulls back. Because right now we don't have that yet. We have an early sign of like, oh, the market is kind of reacting here nicely, right? Double top. But we don't get this yet. Who knows? Maybe by tomorrow we're gonna get that, and then by Thursday we get this. By Friday, US session, maybe we get completed, and then we can look to sell, right? So what I'm looking at is, I mean, the market is still moving, right? So what we're looking at is if we can get an impulsive push, if we can get a pullback correctively, we can potentially get a sell opportunity. All right, so that's the directional bias I'm looking at. Downside. Okay, now obviously, do we have a setup now? No, right? Because as I mentioned, we need some of these moving parts to complete itself first, then we have that setup. Okay, because today, if I bring you to the lower time frame, okay, so I mean, you need to have the ability, or you need to train yourself to do the ability of what we call forecasting, right? So if you kind of look at this here, what do we have? We have, of course, the high time frame is there already, right? Then we have this here where the market can break the low, sorry, break the high, right? But then after breaking it, it kind of reverses very, very quickly. Now, why I say it's still an early sign, because you can see this low is the market did successfully break it, but again, it's not a very decisive break. Just a little bit of break, right? But of course, if today the market continue to come lower like that, right, then that becomes a very decisive break. It's a very clear break. Okay, now if it's a very clear break, means it's impulsive. Great. Then we wait for the pullback. Don't we have a setup here, right? So we have the liquidity sweep, change the character. This is impulsive. We can then wait for the pullback. can see the application of the process, right? Now, if it's gonna be a pullback here, and let's say successfully the market does something like that, this is the entry, stops, and take profit, right? This context of this, the context of this trade here is a alignment with a higher time frame direction, right? Because today, if I'm going to look at potentially a sell trade here, all right, I can go for extended target. Why? Because on the high time frame, we're looking at downside. Okay, we are not trading the pullback itself. We are potentially trading the overarching direction. So this means that I can potentially aim for all the way to this low at 3010. Okay, so I mean, this is not the final setup, right? But just give you an idea. If today we stretch this to 3010, okay, roughly there, it's a 4.3 risk to reward ratio. Okay, um, that is huge, right? Because if today you're gonna risk 1%, then this trade potentially can make you bet 4%. Okay, um, so that's the idea, right? So you can see how, again, the application of the framework and how I actually do my analysis and prep work. Okay, so that's one of it to have in your watch list, right? Pound dollar. Aussie dollar is another one you can keep watch. The principle of Aussie dollar on a high time frame is very, very similar to pound yen. Okay, so what we see here is we have this very, very strong impulsive push. Um, Without any significant pullback, right? So that's where we can anticipate, all right, the market would likely pull back. Pull back to where? 15,618. Okay, which means in the near term, if the market's going to pull back, it's going to come down, then my directional bias here is, right, I would look for short-term sell. All right. Um, can get that, right? So that's the directional bias. Then the context obviously is, does it make sense in terms of the room that it can travel? Yes, right? Um, And then the context of this, if I'm going to sell it as a pullback trade, so maybe my take profit is not going to go like super extended, right? However, if you go down to the setup phase of this, we don't really have a setup yet, right? Because today, if I want to sell, what's my model? My model is I need to have this, okay? Similar, looking pretty similar. We kind of have this part, okay? But we don't have the break part, right? We don't have this part. We don't have this, okay? But who knows? Again, the market is developing. If we get an impulsive drop tomorrow, which is Wednesday, and Thursday it starts to pull back, Friday it starts to pull back, and Friday London session, we might get that, right? Because then this would form something like this. Then that's your model. Can you see that? Okay, obviously then we also need some sort of a fair value gap market or the block. Okay. So it's still developing, potentially is building up, but of course, if this just breaks it, right, then you need to kind of like evolve with the market, right? If it breaks this and it just comes back down again, it's still valid, right? Because then this is your liquidity strip, this is your this is your market structure break, and then you just wait for the fat again. It's the same thing. Okay, it's a very, very repeatable process, right? So you can see, right, the setup is not there, but you can do a little bit of planning. Okay, so that's another one to keep watch, right? Aussie dollar. Um, Silver. Okay, silver here is another one that is very, very similar to Aussie dollar. So on the high time frame here on the H4, what we are seeing is that we have this 1, 2, 3 WXY come into the key area. The market is kind of reacting off that key level, but not with confirmation yet. Okay, so what I mean by confirmation is obviously we want to see some sort of impulsive drop, right? And then again, what we are expecting, this is extended, we're expecting a pullback, key level, short term, we can be bearish bias. Okay, so again, I'm going a little bit faster, but I hope you can catch on, right? You can see the whole process is kind of repetitive. Okay, very similar. Okay, so this one here in silver, again, if you go down to the lower time frame, we don't have a setup now yet. Okay, but you can see the model is building up, right? Liquidity sweep, this low, if it comes down impulsively, that's a break. If there's some sort of order block, wait for the pullback, your sell setup is completed, right? Because then this is the model, right? Can see similar kind of drawing. Okay. So another one that I think it's worth having it in your watch list. Now, when I mean watch list is basically things that are worth keeping an eye on. It doesn't necessarily mean you're gonna get a setup. But it just means that you want to pay a little bit more attention to them. Okay. Now, I mean S&P here kind of similar as well, right? I mean S&P and silver, you can see the context of things, the structure of things are very, very similar. But I'm gonna give you an example where there just isn't anything. Okay. And as a trader, it's also important to come to the conclusion and say that, all right, there's really nothing there. I don't want to force something in. Let's move to the next one. Okay. Because I feel that a lot of times, one of the mistakes that traders put is that they try to force something into the chart. Okay. Where there's really nothing. Okay. So I'll give you an example. Okay. Today you open up a chart like that on Aussie yen. You look at it and you ask yourself, right, can you really identify a clear pattern, right? Probably not, right? Again, the simplest pattern of all is impulse correction, okay, or impulse crawl, okay. These are clear patterns we can kind of recognize. There are a little bit of an element of a crawl potentially developing, but it's still really too early. And if you kind of look at it here, we have like this high with this low, but then the market is basically trapped within this kind of like range. Okay. Sorry, my drawing is a little bit bad, but you kind of trapped within this range. That's it. Okay. So again, we don't need to squeeze something in, right? We don't need to kind of force an analysis on a chart where things are not clear, because I've shown you examples where things are clearer, right? We rather have our resources focus on that, right? Which is where the watch list is. Um, so when you open up a chart and you can't encounter something like that where things are not clear, there's no clear pattern, you're kind of doubting yourself a little bit, you kind of like, hey, you have the element, right? It's like not clear, okay? Um, be very, very comfortable in saying that there's really nothing there and then move on to the next instrument. Okay, I've seen a lot of traders try to force something in, which means that even if they don't trade it, they try to force an analysis to it, which is unnecessary, because if things are not clear, there's no trade. You don't want to spend too much time on it, right? So usually when I look at things like this, I would say, okay, it's not there's no clear directional bias, it's neutral, move on. Okay, eventually the market will give you something clear. It's just not at this current moment. Okay. So things like that, you can just move on, right? Things like gold here is a little bit of a crossroad. It's a bit more complex. Again, there are some charts that is easier for you to analyze and come to conclusion. There are some charts that require a little bit of experience and practice. Okay. So again, depending on which stage you are in your trading, if you're very, very new, my suggestion is skip things that are not clear. If you're a little bit experienced, like go here, right? Why I say it's a little bit more advanced in the analysis of this chart is because I'll take away this drawing first here, right? It's really because we are at a crossroad, right? When I mean crossroad here is like 50-50 in a way, right? Because the market has break this high, but currently you can observe the market after breaking, it did not continue higher. It starts to come down, but then this move to the downside is again not very committed. Okay, now if today the market breaks it with momentum, it becomes very clear. If today the market breaks and comes back down very fast, it's very clear. But right now we don't get either of that. We get a break, we don't go up anymore. We are starting to come down, but we don't come down very, very decisively as well. So things like that is what I mean by crossroad, which means you want to give it maybe a day or two and see how the market is going to develop next, right? Because if tomorrow we open the market, we open the chart, the market does this, then it becomes clear, right? Because this is a rejection down, then there's very likely who the market will continue lower. Okay, then we have a clear directional bias. Then we can work on it. If tomorrow the market still consolidate like that, then there's really nothing there. We give it more time. Okay. So this are example where it's a little bit more advanced, where you need to be very clear of your pattern structure, right? You need to be very clear in terms of like what are some of the possible scenarios in which price can develop, and then you can categorize as, okay, if scenario A happens, this is the analysis I'm gonna have. If scenario B happens, then this is the scenario and analysis I'm gonna have. Um, so it takes practice, right? Um, Something that I feel it's very powerful from Elliott Wave is the ability to do forecasting and do prep work. Meaning I can, with the understanding of Elliott Wave and the application of Elliott Wave, I can do exactly what I've described to you. Okay. And having the ability to do that as a forecasting, as a prep work, psychologically, it will give you the confidence to approach the market. Okay. Because in a way, you can cover almost 90% of what the market can likely do, right? Again, it's not going to be 100%, but a lot of the potential scenarios you can actually plan ahead. Okay. And then, of course, depending on what scenario eventually turn out to be, you follow that trade plan from there. Okay. So, gold here is a very good example of what I mean by crossroad, right? Which means at this very moment today, right now, we don't really have a clear analysis bias. But going forward, depending on which scenario the market turns out to be, we will then have clearer directional bias that we can work on. Okay. So again, things like that would more like, if I can't put it into tiering, right? Things that are clear, such as pound dollar, Aussie dollar, silver, those I'll put as tier one. Okay, of course, that includes pound yen, which have a setup and things like that. Those I put it as tier one, which means primary focus. Gold, is an example of what we call tier two, meaning if you don't have a lot of things on tier one, you have extra capacity that you can work on. You can then focus on things like tier two, like gold, right? Which means tomorrow you come back, you look at it, how is it developed, then you put on your analysis. What is tier three and is not worth looking at is odd yen example, right? Because odd yen, again, is nothing there. There's no basis that we can even work on, right? So things like that, I'll put it as tier three, which means absolutely this week, probably you don't want to spend any more time on it. Okay. So again, the layering of this hierarchy is also important because then it gives you an idea of what to focus on, right? Because the worst thing you want to do is kind of diversify your focus and then you get distracted and then you make mistakes as well. Okay. So that's something to note, right? And lastly, I also want to talk about pairs like that. Okay. This is Pound Australia, right? We have some sort of a clear directional bias, but you can realize you start to realize that this move down here is pretty choppy, right? I mean, this is on the 4 hour time frame, but you can see like one black candle, one white, one black, two black, and one white, one black, two black, three black. But then um there's a lot of ups and downs, right? As this is coming down. When you start to observe things like that, it's also kind of indicate that the market momentum is lacking. It might not be the best possible move. Okay. So this is context where if I see something, okay, you can just compare this move here and this move here, right? Very, very clear, right? This gives me confidence of a down move. This doesn't give me confidence of a down move. So when we don't have that momentum, okay, sometimes you also want to be patient, which means things like that, I'll put it as tier two. Okay. So since we're on the topic, right, I just want to cover a little bit on that, right? So these are things that I'll put on tier two, which means if I have better opportunity, I'll focus on the better ones. Okay. So as a swing trader, right, which means I'm looking at 4 hour and then H1 is my execution, right? As a swing trader, do I get trades every day? No. Okay, what's the statistical number? It's actually about, on average, 1 to 2 trades a week. But just bear in mind that you don't need a lot of trades within a week or within a month to see results. Okay, because we're talking about swing trade here, which means you technically don't spend too much time in front of your computer as well. On average, I spend about like 30 minutes a day and then that's it. I'll put in my order and then the rest of the day is more like just management of it, right? Then in the morning again, the new day, I just spend another 30 minutes to update my analysis, see if there's any new trades and then update the trades accordingly. And that's it, right? So on average, about every other day, we spend about 30 minutes in the market. So I want you to have the perspective that as a swing trader, you don't get a lot of trades. There are benefits to it. Number one, you don't need to spend a lot of time monitoring the market, right? But at the same time, you can actually really squeeze money out of it. Number two, okay, it's a very chill and relaxed way of trading, right? Because you don't need to kind of commit like, oh, every day New York session 8 to 10, I need to sit in front of my laptop, right? You have the flexibility of really doing other things. Okay. So a lot of traders misunderstood that, oh, the more you trade, the more profit you're gonna get. Not necessary, because the more trades you take, the more stressful you can become, the more mistakes you can make psychologically as well, right? So little details like that comes from my personal experience. I thought it's important to share with you guys as well. Okay. So a couple of things we walked through. I think last one here, just talk a little bit about BTC, right? So BTC has been falling quite a bit on the daily scale, right? This is a bit clearer on the daily scale. Okay, so it's definitely coming down. I think the momentum is still there. From Elliott wave perspective, if we get a corrective pullback towards the key level around 94,240 range, we might still see one more push towards this low here. Okay, which is around 77,000. So again, this gives you a framework or a kind of directional um, structure to look out for, right? Because short, if you're very, very short term, you can look for this push up. When it reaches this key level, you can look for the swing sell down. And then after, when it reaches, you can look for the long term buy. Okay. So these are things that you can look out for as well, right? In terms of BTC. Good. Okay. Great. So very, very quickly, you just want to check, is there any questions? Okay. Is there any questions from you guys? Okay. Any questions from, or any particular instruments you'd like me to walk through? You guys. All good? Okay. So I think if there's no questions, then generally the sessions that I have is up to here. Let me just very, very quickly put this up. Okay. So yeah, I hope for the past 4 sessions so far, you guys have been enjoying the entire series, right? And hopefully also gain some insights and knowledge about it that might be able to help you in your own trading as well. Okay. So, yep, that's all I have. All the best in your trading journey. And of course, just general reminder, always plan your trade your plan, and manage your risk well, right? So if I have the opportunity to see you guys and share with you a little bit more in the future, that will be my pleasure. If not, then all the best. As I said, see you guys in the future. Um, yeah, I'll put this up for a little bit while and see if you guys have any questions, right? But if not, then I think that's all for today's sharing.